I think Bitcoin will tap $10,000 from its high of 65,000 because that's what it normally does. It drops 85%. Ethereum usually drops 95% because it has lower liquidity, so it acts like a leverage position on Bitcoin to some degree.
The people in the Bitcoin ecosystem tell me, look, Bitcoin is unlikely to do what it has been doing in the past couple of cycles, which is drop 80%, precisely because new institutional money have already been placed in the Bitcoin ecosystem. Institutional investors now with more money are likely to make the coin less volatile, so to speak.
It's not true.
How would you respond to that?
They're wrong and I'm right. I have a history of calling the top. I called the top on the day. I called the $65,000 top on the day and drew the chart. And then I told you that last cycle, Ethereum topped 27 days later. Guess what happened this cycle? Exactly 27 days later, Ethereum topped. So all those guys that have these fan fiction theories about, the price can't go below the cost of mining. They think that the cost of mining holds the price up. Nope, didn't last cycle, won't this cycle. Mining price follows the price. It doesn't lead it. People look at trailing indicators and think they're leading indicators, like Google search volume. You can't trade the Google search volume because it's a trailing indicator, not a leading indicator. These are reflexive systems. They do not have base demand. You do not have to pay your rent in crypto. It is a purely speculative play. The people bought because the price went up, so they bought, so the price went up, so they bought, so the price went up, and then it gets punched in the nose hard enough where it drops outside people's comfort zone, and the people that bought the dip lost. You could have bought 20% dips the whole way up for a year and made a killing. But this time, when you bought the 20% dip, you lost half your money. And now people will sell because the price went down, so they'll sell because the price went down, so they'll sell because the price went down. And this concept that the world's richest guy can buy, who do you think is going to follow him up? You got another world's richest guy waiting behind there to follow him up, to buy his bag, to buy the top right after him? It's crazy. No. Once you've already got the world's richest guy on board, it's time for a dump. You got him. And then when you finally shake everybody out and you get the last weekend out, then you get to go up again.
All right, so price call history aside, so you're talking about a drop down to $10,000. Why are we in a bear cycle right now?
Well, basically, in a reflexive system, you have a parabolic rise up. And what that means is that you make larger candles in shorter time frames. So candles have, usually you're watching the daily candle, weekly candle, and they get longer and longer and longer in shorter and shorter time frame, and it looks like a hockey stick. And when you finally fall out of the parabola, the rule of thumb is that you drop 85% of the move. But in Bitcoin, you don't just drop 85% of the move normally, you drop 85% of the total. So we have seen hockey stick run up, fall out, drop 85% over and over and over again. And you know what else we normally see? There's a chart you can Google called the psychology of a market bubble. Run up, dump, return to normal, the bull trap. This is where we are now, in my opinion. So Bitcoin went in 2017, end of 2017, it went to 20,000, dumped to 10,200, and then went back up to 17,400. It went back up from 10 to 17. It went up 70% again. Got everybody along, down to 6,000, bounced a little bit, trapdoor opens down to 3,000. Bump and run bottom, up to 14, which was a Ponzi scheme out of China called Plus Token. Then they got arrested. Day of their arrest in China, doom. Back to 3,800, find a bottom, go back up, COVID dip. So there was a thing called, I'll tell you where I learned this. I'm the person that popularized this idea. I call it Hart's Law, that the reason all prices move together when things are traded versus each other is because they're bonded together by the liquidity in their pair. There was something called unisocks, literally just a pair of socks. They created a trading pair versus the Ethereum unisocks pair. Ethereum price goes up 20x. Guess what happens to the price of a pair of socks? It goes to $40,000. That's when I learned, wait a second, these socks aren't worth $40,000. Why are they priced at $40,000? Because you can exchange them for something that went up in value 20x. And so when you have things that are tied together that are interchangeable, anytime one of them goes up versus $1, it pulls them both up versus $1 because they're interchangeable.